The IMF's warning this week was quiet, technical, and far more dangerous than most headlines made it sound. Global growth for 2026 has been cut to 3.1%, and the fund says the world is already drifting toward an adverse scenario closer to 2.5% if the Middle East war drags on. That is not just slower growth. That is the edge of something much harder to stabilize once debt, inflation, and higher rates start feeding each other. And that is why this story matters now. The problem is no longer simply that war raises oil prices. The problem is that many governments are entering this energy shock already carrying heavy debt loads, rising interest bills, and weaker fiscal space than before the pandemic. In that environment, another sustained commodity shock does not just hurt consumers. It changes what central banks and treasuries are able to do at all. The phrase fiscal dominance sounds academic, but the idea is brutally simple. When debt is high and budgets are under strain, rate hikes become politically and financially harder to sustain because tighter money can quickly worsen public finances and market stress. The IMF does not present that as a certainty, but it explicitly warns that central bank credibility helps protect against fiscal dominance at exactly the moment inflation risks are rising again. That is the trap. Governments need tighter money to stop an energy shock from turning into entrenched inflation, but tighter money also raises borrowing costs, stresses rollover needs, and makes debt dynamics uglier. So the world is being pushed toward a point where fighting inflation aggressively can threaten fiscal stability, while going easy on inflation can undermine currencies and credibility. Pick your poison. If you want clear, fast breakdowns of the economic pressures reshaping global power, subscribe to Signal Drop now, because this is no longer just a debt story. It is a story about what war does to countries that are already running out of room. And this is not a theoretical danger reserved for small economies. The IMF says global public debt rose to just under 94% of GDP in 2025 and is set to reach 100% by 2029, 1 year earlier than it projected just a year ago. Kristalina Georgieva said that level would be the highest since the aftermath of World War II. This is not a niche debt story anymore. It is the background condition of the world economy. The war shock makes that baseline worse. The IMF's April outlook says the conflict has already damaged critical infrastructure, severely disrupted maritime and air traffic, and is hitting economies worldwide through higher commodity prices, tighter financial conditions, and second-order inflation effects. This is exactly the kind of shock that arrives at the wrong time for indebted governments, external, inflationary, and hard to offset cleanly with domestic policy. And the market side is already moving. The IMF's Global Financial Stability Report says global equities have fallen, bond yields have risen sharply since late February, and financial stability risks are elevated as the war raises inflation concerns and threatens tighter funding conditions. That matters because sovereigns do not borrow in an emotional vacuum. They refinance into whatever market they actually get, not the one they wish they had. So the real question is not whether the world can survive one more energy shock. It probably can. The real question is whether highly indebted governments can absorb repeated shocks without losing either inflation control or market confidence. That is the fiscal dominance trap in plain English. Too much debt, too many emergencies, and too little clean room for policy. Start with the IMF's reference forecast. Under the assumption of a limited conflict, the fund now sees global growth at 3.1% in 2026 and 3.2% in 2027, both below recent outcomes and well under pre-pandemic averages. It also says global inflation will tick up in 2026 before resuming decline in 2027. That is already a worse mix than policymakers thought they were dealing with at the start of the year. The downgrade is not random. The IMF says the pre-conflict growth forecast for 2026 had actually risen to 3.4% before the war. Then the war hit, supply routes broke down, commodity prices jumped, and the outlook darkened. In other words, this was not a weak global economy stumbling on its own. It was a more resilient baseline suddenly clipped by geopolitics. That makes the policy challenge even more frustrating. Emerging markets are taking a disproportionate hit. Reuters reported that the IMF cut its 2026 growth forecast for emerging market and developing economies to 3.9% from 4.2% in January, warning that higher energy and food costs would hurt vulnerable commodity importing countries the hardest. These are exactly the places where fiscal space is already tight and domestic resilience is often weakest. And this is where the warning turns from technical to political. The stress is already pushing countries toward the IMF's door. Reuters reported that the fund expects at least a dozen countries to seek new loan programs to cope with surging energy prices and supply chain disruptions caused by the Middle East war. That tells you the pressure is not a 6-month theoretical scenario. It is operational right now, especially for countries that import energy and do not control reserve currencies. The IMF's fiscal message is equally stark. Its April fiscal monitor says public finances are under strain from social spending, defense, strategic autonomy, and rising interest burdens, and that the fiscal consequences of the Middle East conflict add further fragility. That list matters because governments are not simply choosing between butter and guns anymore. They are choosing among welfare pressure, security pressure, and debt service all at once. The interest cost story is especially ugly. The IMF says interest spending has climbed rapidly from about 2% to nearly 3% of GDP in only 4 years. That may sound dry, but it means more tax revenue and more borrowing are being diverted just to service old debt. In a world of new energy shocks and higher military spending, that is exactly how fiscal flexibility quietly dies. And debt is not just high, it is becoming more dangerous. The Fiscal Monitor says global debt at risk 3 years ahead is now approaching 117% of GDP under downside scenarios. Reuters separately reported that under severe conditions, debt could reach 121% by 2029. That is the IMF effectively telling governments that the bad path is no longer a remote fantasy. It is a live tail risk. Then add defense spending. The IMF's April World Economic Outlook says defense buildups can support activity in the short term, but they also worsen fiscal deficits by about 2.6 percentage points of GDP, raise public debt by about 7 percentage points within 3 years, and create significant medium-term challenges. So the same governments now rearming for a more dangerous world are also making their fiscal problem harder to control. That alone would be bad enough. But then the inflation channel comes back in. This is where the story gets more serious. The war shock is not colliding with a neutral fiscal background. It is colliding with a world already paying more interest, already borrowing more for security, and already dealing with fragile political coalitions that dislike austerity. That is why even a moderate energy shock can produce an outsized policy crisis. The starting point matters, and the starting point is weak. If you want analysis that cuts through the jargon, this is the key point to hold on to. The danger is not that every country suddenly goes bankrupt tomorrow. The danger is that too many countries become less able to fight inflation, less able to subsidize households, and less able to finance security spending without eroding confidence. That is how a macro problem turns geopolitical. Now bring in energy. Reuters reported that the IMF, World Bank, and IEA called this the most severe shock to the global energy market in history and urged countries to stop hoarding supplies or imposing export controls. That appeal tells you policymakers already fear the normal reflexes of crisis politics. Stockpile, subsidize, and protect the domestic voter, even if it makes the collective problem worse. The IMF's fiscal advice reflects that fear. Reuters reported that the fund explicitly cautioned countries against broad fuel subsidies and instead urged targeted, temporary support for the most vulnerable. The reason is simple. Broad subsidies suppress price signals, increase budget strain, and can push global demand higher when the whole point is to reduce it. Governments love them politically. Economists hate them for a reason. That advice is also a clue to the underlying trap. If governments had ample fiscal space, they could cushion households more generously while central banks focused on inflation. but the IMF is telling them to be selective precisely because fiscal space is scarce. In other words, the policy menu is already being rationed by debt and borrowing costs before the crisis has even fully played out. That is where the room starts disappearing. And central banks are being dragged back into the fight. Reuters reported that the IMF's European department expects the ECB to raise rates by about 50 basis points in 2026 to maintain a neutral stance in the face of the energy-driven inflation surge. That may sound manageable, but it illustrates the core problem. War raises inflation, inflation requires tighter policy, and tighter policy raises pressure on indebted sovereigns and rollover-heavy debt markets. This is where fiscal dominance stops being an abstract label. The IMF's World Economic Outlook says central bank independence and credibility help anchor inflation expectations and protect against fiscal dominance. That wording implies the risk is real enough to name, a world in which debt pressures and fiscal needs make it harder for monetary policy to do what price stability requires. Once credibility weakens, that balance gets harder to hold. The market structure of debt makes it worse for some countries. Reuters reported earlier this month that portfolio investors' share of emerging market debt has doubled to 80% over the past 20 years, and that sudden outflows can trigger sharp currency drops and wider sovereign spreads. That means heavily indebted governments are not only exposed to higher rates, they are exposed to fickler creditors too. So imagine the sequence. Oil jumps, inflation expectations rise, the central bank tightens or is expected to tighten. Bond yields rise, foreign investors reassess, currency pressure builds, debt service worsens. Then the government faces pressure to subsidize fuel, protect households, or increase defense spending anyway. That is not a dramatic movie script. It is exactly the kind of chain reaction the IMF is warning about. So, what breaks first in a shock like this? Inflation control or fiscal stability? Drop debt if you think governments will protect budgets first, or rates if you think central banks will be forced to stay harder for longer. Europe is not immune just because its institutions are richer. Reuters reported that Italy must roll over debt worth 17% of GDP in 2026, compared with 12% for France and 7% for the UK and Germany. The impact of higher yields arrives gradually, but it does arrive. Countries with large refinancing needs feel rate shocks not as a headline, but as a recurring bill. And that is before you add rearmament. Across advanced economies, governments are being asked to spend more on military capacity and strategic autonomy, just as interest burdens rise. The IMF says these pressures are already part of the deterioration in the fiscal outlook. So the fiscal dominance trap is not only about weak countries, it is also about strong countries being forced into harder trade-offs than they are used to admitting. Latin America and the Caribbean offer a snapshot of how uneven this shock can be. Reuters reported that the IMF expects the Middle East war to widen economic differences across the region, giving some short-term support to oil exporters while worsening the outlook for tourism-reliant Caribbean economies and energy-importing countries in Central America. That is a reminder that one global shock rarely lands evenly. It redistributes pain. The same goes for emerging economies more broadly. Reuters reported that countries such as Senegal remain under pressure from undisclosed debt problems and painful fiscal consolidation, while other low-income and lower-middle-income importers are confronting higher food and energy bills. So when the IMF says new loan requests are coming, it is not talking about one neat category of victims. It is talking about a broad field of vulnerability. Reuters' dispatch from the IMF meetings captured the mood well. Finance leaders said their ability to cushion repeated geopolitical shocks is diminishing, and many were openly frustrated that solving the latest crisis still depends largely on political choices in Washington and Tehran. That is what fiscal constraint looks like at the global level. Not just less money, but less control. Here is the core revelation. The debt problem and the war problem are no longer separate stories. Higher military outlays, strategic stockpiling, industrial policy, and energy price shocks all feed into public borrowing and inflation management. The IMF is effectively saying the world is entering a phase where security policy and fiscal policy are now tightly welded together. Once that happens, macroeconomic mistakes become geopolitical liabilities. That is why the phrase fiscal dominance trap actually fits, not because every central bank has already lost independence, but because the margin for acting freely is shrinking. The IMF still emphasizes the importance of credibility, discipline, and targeted support, which means policy choice still exists. But those recommendations also reveal how narrow the lane has become. Governments are being told to do more with less room for error. And the energy channel remains the accelerant. Reuters reported that even under the IMF's reference case, emerging market commodity importers will be hit hardest by rising energy and food costs. If the conflict lasts longer and oil remains elevated, the IMF says the world drifts toward an outcome much closer to recession. That is exactly the sort of external shock that can force central banks and finance ministries into open conflict with each other. The political temptation, of course, is to fake your way out, delay consolidation, offer broad subsidies, pressure the central bank to look through inflation, borrow short and hope rates ease before refinancing bites. None of those options solve the structural problem, and the IMF's repeated calls for rebuilding buffers suggest it knows many governments will still try them anyway. That is how fiscal fragility turns from a warning into a regime. The uncomfortable truth is that democracies often discover fiscal limits only after markets start enforcing them. Governments can ignore economists longer than they can ignore funding costs. The IMF's reports on rising yields, high debt, and fragile financial conditions are essentially warnings about where that enforcement may come from if policy credibility slips. Bond markets are boring until they are not. That is why the safest countries are not necessarily the ones with the lowest inflation today. They are the ones with stronger institutions, more credible monetary policy, deeper domestic funding markets, and more room to reallocate spending without detonating politics. The IMF's own framing points in that direction when it stresses credibility, independence, and targeted support over blunt fiscal expansion. Those are not moral preferences, they are survival tools. And the weakest countries are not necessarily the poorest on paper. They are the ones that import energy, depend on volatile external financing, face rollover pressure, or carry fragile political coalitions that cannot absorb austerity. Reuters reporting on emerging markets, loan demand, and portfolio-driven debt financing shows how quickly those vulnerabilities can stack. One shock is manageable, several at once become something else. If this breakdown is helping you see the system beneath the headlines, subscribe to Signal Drop and drop debt in the comments. Because the real danger is not only what the war is destroying on the ground, it is what the war is exposing in public finances everywhere else. How many governments were already living on borrowed room before the next emergency arrived? The hidden cost is strategic. Countries under persistent fiscal pressure project less power, hedge more nervously, and become easier to coerce through energy, trade, and capital flows. Reuters' commentary this week made exactly that point. Debt-fueled rearmament and higher borrowing costs can limit states' ability to project power. In that sense, the fiscal dominance trap is not just an economic story. It reshapes the balance of power. It also changes how crises spread. In a healthier world, a regional war might remain a regional war. In a debt-heavy world with elevated rates, it can move quickly through oil, inflation, yields, currencies, and sovereign balance sheets. The IMF's latest World Economic Outlook, Fiscal Monitor, and Global Financial Stability Report are all effectively saying the same thing from different angles. The transmission channels are now wide open. So, what should we watch next? First, whether oil and gas disruption stays temporary or becomes structural. The IMF's reference scenario assumes a limited conflict. The adverse scenario gets much uglier fast. If the conflict broadens or supply constraints persist, the global macro path changes from slowdown to something much closer to a recessionary squeeze. Second, Watch subsidy policy. If governments ignore the IMF and go broad on fuel relief, the budget damage and demand distortion could become part of the next inflation wave. Targeted, temporary support is politically harder to sell, but economically far less destructive. When policymakers choose the easier option in a debt-heavy world, they usually pay for it later with higher rates and weaker credibility. Third, watch refinancing calendars and foreign investor behavior, especially in emerging markets and high-debt European states. The countries most exposed are the ones that have to return to the market often and cannot fully rely on stable domestic funding. Rising spreads and weaker currencies are usually not the first symptom of fiscal trouble, but they are often the first one policymakers cannot talk away. Fourth, watch the relationship between finance ministries and central banks. The IMF is still betting that credibility and independence can hold the line. But if inflation stays sticky while governments keep borrowing for defense, energy relief, and social stability, that relationship will become the fault line of the next phase. Fiscal dominance is not a cliff, it is a tightening corridor. That is the real meaning of the IMF's warning in April 2026. The danger is not simply that debt is high or that war is expensive. The danger is that the world now has too much debt for repeated geopolitical shocks to remain just geopolitical. They are becoming monetary shocks, fiscal shocks, and ultimately power shocks. And once that cycle starts, governments do not get to choose only one part of it.